Can you smell the storm brewing? 2024 could be that year when a lot of people will either make it or break it. Inflation is soaring, and there are indications of an impending recession crisis. Everyone has got to diversify their income and make extra cash. It's one of the reasons why this quote from Warren Buffett is timeless. If you don't find a way to make money while you sleep, you will work until you die. In this video, I'm going to share 7 of the best cash-flowing assets for passive income. And believe it or not, you'll be stunned by how lucrative they can be. Please note that this isn't one of those get-rich-quick Ponzi schemes. While I can guarantee you'll make a lot of money from these assets by doing next to nothing, you're not going to have $1 million overnight. As a matter of fact, you'll have higher odds of seeing a pig fly. Secondly, I'd like to add that whether you have a hefty sum to begin with or not, there is a ticket available for everyone on the passive income train. Some of the assets I'll be telling you about shortly only require a little capital. Number 7. High Yield Savings Account. In a bid to weather an economic storm, a lot of people make terrible investments and end up shooting themselves in the foot. But believe it when I tell you that saving money and investing in high-yield accounts can never be one of them. It's flexible and safe, and your money can be accessed whenever you need it. The thing about high-yield savings accounts is that they aren't just a secure home for your cash. You'll also be earning passive income daily, thanks to the fact that high-yield savings accounts compound interest every day. And the icing on the cake, you don't even have to start with a lot of money. A weekly deposit of $20 can give you $1,000 in a year. At the moment, some high-yield savings accounts offer 4 to 5% interest rates, often without requiring a minimum account balance and without early withdrawal penalties. So it's kind of like a win-win on all fronts. Remember what we talked about regarding inflation rates? Let's assume the worst really happens. Did you know these accounts can help you avoid losing money? Walk with me here. If inflation is higher than your interest rate, you'll lose a bit of your buying power, but by putting extra cash into a high-yield account with above-average ROI, you'll either make up what was lost or soften inflation's blow. Looks pretty good, right? Before I go into the next asset to consider buying, I'll advise you not to substitute high-yield accounts for long-term investing. If the Fed cuts rates, high-yield accounts will lower theirs. It's perfect for gaining passive income for some months, but I recommend replacing it with long-term investing, which will have higher expected return than cash savings over many years or even decades. Number 6. Single-family rentals. There's a reason why the best type of real estate to own is a single-family home rental property. If you have the capital to start, I guarantee you'll never need to work so hard anymore. Opting for a single-family home rental brings the advantage of lower maintenance needs due to less square footage and fewer elements to manage. Even if the property is far away, you wouldn't necessarily have to get a property manager. Have you ever noticed the rich always keep winning, no matter how bad the economy gets? You don't believe me? How about you hear it right from the Oracle of Omaha's mouth?
Who's winning?
The extreme rich are clearly winning. If you look at the Forbes 400, they had an aggregate net worth of $92 billion in 1982. It's $2.3 trillion today, 25 times as much. The very rich have done exceptionally well in this economy. Other people have done okay on balance.
Let's consider Alex, a rich investor who is worth millions. If he wants to buy a Ferrari, he'll get an investment that brings in enough money each month to pay for the Ferrari's monthly payment. Once it's cleared off, he'll own 2 things: the Ferrari and the investment that'll keep on giving him passive income year after year. Rinse and repeat. One of the things I love most about property rentals is that they're perfect for the long term. More and more people are choosing to rent instead of buy. And believe me when I say the trend won't be stopping anytime soon. Just think about the amazing benefits of renting your property. In every single market, whether it's up, down, or sideways, you're gonna still make money. It's passive income at its finest. I want you to think far ahead, far beyond your paychecks and up to your retirement. Would you be able to live comfortably when you're not able to work because of your age? Sure, you may have Social Security, a decent pension plan, savings, and an IRA. But while all of these things are good in theory, that's not how the rich keep winning. Rental properties provide a consistent cash flow, putting money in your pocket every month. Each rent payment from the tenant not only means immediate income, but also contributes to building long-term wealth. We're talking hundreds of dollars a month or more, depending on the area. That said, single-family home rentals are long-term investments. It's one of those things you buy and keep holding forever. Number 5. Car rentals. You might want to look into the car rental business as an alternative to property rentals. While the former requires substantial capital to begin, car rentals wouldn't, given how you've already got a car. Hey, have you ever heard of a man named Jack Taylor? Before he died, he owned a rental car company, and long story short, he flipped it into a generational wealth generator. You don't have to take my word for it. Here's a glowing testament from Warren Buffett.
When he died, his rent-a-car company, starting with those 17 cars, was worth more than Hertz and Avis and all the rest of the rental cars put together. The man's name was Jack Taylor, and his son, Andy Taylor, is a good friend of mine, runs the business now. A grandchild is in the business. They'll probably be a fourth generation.
Guys, it's not rocket science. Making a lot of passive income from renting your car is easy. And it works amazingly well in the economy, especially if you live in one of the booming cities like New York or San Francisco, where you can charge much higher rates. And the best part is that you won't need to spend time behind the wheel or interacting with others to earn money sharing your car. Another perk of renting a car is that the prices are based on a ton of variables. If you have a sought-after car, you can charge more than others, especially on the weekends. Let's say you have a 2021 Range Rover, and you charge between $90 and $100 a day from Monday to Thursday, and around $130 on the weekends. Once you start racking in passive income this way, you can use the funds to pay off your car loan, or better yet, turn a profit. That said, I will advise you to be reasonable with your pricing. There are a lot of car rental apps out there with many lenders, so you'll always have to ensure that you are priced well among your competitors. Number 4. ATM machines. Did you know there are about 40 ATMs for every 100,000 people worldwide, and each is used about 300 times per month? Let me tell you something that's really going to blow your mind. The North American ATM services market hit $6.8 billion in 2020, and it's projected to experience a compound annual growth rate of 6.5% through 2028. Whenever you purchase an ATM and put it in a place that generates high traffic, you can earn a lot of passive income through transaction fees by doing next to nothing. Even if cash and coin usage declines, an ATM business will never crumble, especially given that people continue to rely on credit and debit cards to make cash withdrawals. In case you're wondering how ATM machines make a lot of money, allow me to paint a bigger picture. Do you know that there are fees attached to almost every function that is performed on the machine? We're talking about fees that are around $2 to $3 that contribute to the cash flow for investors, especially when considering the core transaction value of the machines across a fund or portfolio. And guess what? Because this flow is powered by underbanked people who use ATMs as their primary option for services, transaction volume on these machines is as solid as a rock, even during economic downturns or other global events like a pandemic. Alas, there is a con. Given that ATMs are a liquid investment, they are not easy to sell. However, if that's not a problem for you, the initial capital to facilitate this investment typically ranges from $3,000 to $10,000. And again, make sure you pick the right location where the machines are in high demand. This is going to be crucial for its success. Number 3, bonds. When it comes to passive income, another amazing option that you need to consider is investing in bonds. These fixed income products can offer steady passive income for a long time. And just like a savings account, they're quite easy. Bonds can pay a lump sum when they mature or provide regular payments periodically. Alright, let's discuss how this works. Bonds are usually split into two forms. On the one hand, we've got bonds from corporations and financial institutions that can give you around 5 to 10% return on investment. And on the other, government bonds that offer 2 to 4% yield depending on how long you want to invest. While there are a couple of ways to invest in bonds, one of my favorites is the passive buy and hold strategy. Here, you're not buying it to flip it immediately. You're purchasing individual bonds and holding them for as long as possible. If you do this, bonds will be like a reliable income buddy. The cash flow will either boost your income immediately, or better yet, give you enough capital to reinvest more bonds, or some of the other assets that we've discovered. Another reason why I personally love passive bond portfolios is that they often act as a buffer in rough financial climates. Plus, if you got into them when interest rates were pretty high, there's a good chance that they will do better than actively investing. Nevertheless, here's a parting piece of advice. Passively investing in bonds works best with top-notch, non-callable bonds, like government, investment-grade corporate, or municipal bonds. Number 2, index funds. Face it, Warren Buffett is a name that's synonymous with Wall Street. In the world of investors and finance, his name is right up there among the very best for so many reasons. As a matter of fact, have you noticed how the world of finance shakes whenever a person withdraws some of his investments from a company? And let's not forget that many people follow Berkshire Hathaway's investments. His influence is simply unmatched. So, when a heavyweight like him keeps suggesting stocks, you've got to believe there's a potential goldmine waiting. To buttress this, here's a clip of him talking about the stock market that still blows our minds to this day.
If you'd been a pension fund and you put $1 million into the S&P 500 at that time and reinvested it, during my investing lifetime, that million would have turned into $5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000.
Guys, investing in an index fund is a smart and easy strategy for growing your money by making passive income over time. You see, time and time again, the stock market always shows tendencies to grow despite short-term fluctuations. Plus, index funds usually reinvest capital gains and dividends automatically. Over time, those reinvestments can lead to compounding returns, which usually occur when your investment has generated additional interest. Finally, index funds tend to have lower expenses compared to actively managed funds, which is perfect because the lower costs ultimately mean more of your investment returns stay in your pocket. It may seem quite small, but as time passes, I guarantee those lower costs will rack up and potentially double your passive income by boosting your overall return. Now, before we go into the number 1 pick for today, have you ever wondered why people lose money in stocks? Warren Buffett was once asked this question in an interview session, and we couldn't agree more with his response.
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. And for whatever reason people give you, you should understand what you buy. Now, if
You've got to be analytical wherever you invest. You've always got to know why you chose whatever stock you did. Here's another piece of parting advice from the Oracle himself.
whenever you buy a stock, let's say you're buying General Motors, you should be able to take out a one-page sheet of paper and say, I am buying the General Motors company at $56 billion because. And if you can't answer that question, if you can't write that out, then you'll go on to something else.
Number 1, dividend stocks. Did you know dividend stocks have historically outperformed the S&P 500 with less volatility? It happens because dividend stocks provide 2 sources of return: capital appreciation of the stock price and regular income from dividend payments. Dividends are like cash gifts from companies to their shareholders, and it's almost like they're saying, hey there, here's a little something for you just because you own our stock and for being a part of the team. And get this, because of their lower volatility, dividend stocks are amazing low-risk investments that are perfect for those who are either looking for some extra passive income or the elderly who are nearing retirement. Imagine you invested $800 in another company, buying 80 shares at $10 each. Let's say each of those shares gives you an annual dividend of 60 cents. That means over a year, you'd receive $48 in dividends. Doing the math, that's a cool 6% dividend yield without you even lifting a finger. What could be better than that? A big benefit of stocks that pay dividends is that they generate a regular stream of passive income, sometimes quarterly. It's a far cry from selling stocks, where you have to constantly monitor the market and know when to sell and make profits. And the icing on the cake, just like index funds, dividends have the capability to compound and increase your investment returns over time. Finally, dividend stocks act as an amazing shield for your investments against the effects of inflation. As you probably already know, inflation has this knack of gradually reducing the buying power of money, which can be detrimental to fixed income investments. But that's exactly where dividends shine the most. You see, dividends have the capability to grow over time, matching or even exceeding inflation rates. Companies that consistently raise dividends do this to cope with increasing costs and maintain competitiveness. If you want to be as rich as Warren Buffett, you've got to think like him. When it comes to buying dividend stocks, he's all about the waiting game of buying and holding. Matter of fact, here's a clip of him giving some honest advice.
I'm not recommending that people buy stocks today or tomorrow or next week or next month, but you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote.
Berkshire Hathaway has an amazing catalog of dividend stocks, which we've talked about in some of our videos already. So feel free to check them out to get the perfect idea of dividends that you need to buy and hold forever.